Hello and welcome to McQuilling TV. I'm Allison Emilio, and joining me again today is Connor Stone, Marine Transport Advisor at McQuilling Services. Welcome back, Connor.
Glad to be back, Allison.
So we're always hearing about the crude export story, but obviously we know that a lot of clean petroleum products are exported out of the U.S. Gulf, and those numbers have risen over the past couple of months. So can you tell us if this has had any impact on MR2 tanker demand?
Of course. Well, it's very important to take a look at this region as an export market because it represents about 24% of global MR2 ton-mile demand. And we've seen U.S. clean product exports average around 8.1 million tons monthly over 2016, and this was up about 2% year on year. However, the increase in volumes wasn't exactly realized in ton-mile demand because the overall average mileage traveled out of this region has been relatively flat to 2015. And this is largely due to increased trading with nations in the Caribbean and South America, which are more proximate. Now, we've seen some recent developments in these nations that might provide some downside risk to tanker trade flows out of the U.S. Gulf into these regions.
Can you elaborate on some of the risks that we might see?
Of course. The first risk will likely stem from Mexico, which is the largest end market for U.S. refined products. Pemex recently announced their intention to boost refinery intake to 1.1 million barrels per day. Now this is 950,000 barrels per day higher than first quarter figures, so quite a significant jump. Now Mexican refineries are classified as simple in regards to their configuration, so they generally run lighter end crudes. And we've seen a reduction in isthmus crude exports, which means more of it's getting locked in the Mexican refining system. So switching to Brazil, we've seen refinery intake also increase there, and it's actually at multi-month highs. And we expect this to continue because there's strong product demand projected over the next couple of months. Now, so you've got rising product output in these two nations, which will likely put some pressure on U.S. Gulf clean flows into these regions. Now, I just want to take a second to take a look at transatlantic flows from Europe into the U.S. Gulf. These flows are likely to be slightly tempered this year because we've seen an uptick in refinery intake in Northern Europe. And this is likely due to good product margins stemming from attractive pricing of regional crudes.
So keeping all of this in mind, what's your view on the earnings potential for MR tankers in the region over the next couple of months?
Well, year to date, we've seen the U.S. Gulf Caribbean trade average around $450,000 on a lump sum basis. And because of the factors I mentioned, the demand-supply fundamentals are likely to shift negatively. So we see this trade averaging just above $400,000 over the next 3 months.
Okay, well, thank you so much for the insight, Connor. It was a pleasure having you here again, and we look forward to talking to you in the next couple of months.
Can't wait to come back.
And that wraps up this episode of McQuilling TV. I'm Allison Emilio. Thanks for watching.